Hello, class. Welcome to our podcast explaining the answers to Chapter 2 homework. Problem 31. We get started. The idea of a phase out of various deductions when the income is higher than usually a threshold, and as the income of the taxpayer is higher than that threshold, then part or all of that deduction or credit could be reduced. Usually some kind of formula to figure out how that is done. You can see there'll be times when it's phased out gradually so that it starts being phased out if their income is $160,000 for example, and it's fully phased out if income is over $200,000. So anything between 160 and 200 might be partially phased out. So something like that. Some of the ones that you see the examples there: earned income tax credit, child care credit, child tax credit, student loan interest. We'll see others as we go through the law, so you could have used other examples as well. Why do they have these? Well, typically it's an idea of fairness. They raise the money coming in by reducing the tax benefits, but only for those who can afford it. So they have the benefit in place for those that have lower incomes, but it loses its value for those with higher incomes. All right, problem 33. First three all qualify as head of household because they maintain a household for someone for more than half a year, okay? And provide more than half that support of someone who's a dependent. Notice that it doesn't have to be for parents the same house. It can be somewhere else. But the last one, because of the time period, they don't qualify as head of household because they were only creating that household from September 1st to the end of the year. So only 4 months, not 6 months required, or over 6 months. So problem 35. The idea of sharing support. There's a concept of multiple support arrangements where a group provides support for someone. Who gets to take them? Who gets to claim them as a dependent? So without a multiple support agreement, no one provides over half support, so no one gets to claim them. And in situation B, even with a multiple support agreement, they cannot, because while Roberta and Bill, which Roberta is the person we're talking about, provides more than 10% of her own support, Bill provides more than 10%. Bill and Alicia are related. We can't count the people that are not related, but Bill and Alicia, two relations, do not add up to 50%. So this group does not have over 50%. So a multiple support arrangement doesn't work because you have to have a group of people with over 50% support. So in C, changing the scenario to where Roberta is not using her income to provide for her support. That means that she's only living on the support provided by others. Then we only have $14,000 of support to divide, you might say. And Bill and Alicia then both together pay over 50%, and both of them individually pay over 10%. So the multiple support agreement could designate either one, or as some groups might do, switch back and forth. 1 year it's Alicia, 1 year it's Bill, depending on their agreement. Again, but that would have to be in writing. That multiple support agreement has to be filed. It is not an automatic. Problem 37, as a dependent, the standard deduction is his earned income plus $350, which is greater than the $1,100 for a typical dependent. So it would be $2,900 as a standard deduction. Now, by the way, if he was blind or over 65 or any of those would be added to that $2,900. But that wasn't the case in this case. Just put that in your back of your mind in case that comes up. And if he was not a dependent of someone else, does not qualify as a dependent of someone else, then it's just a single $12,200 normal standard deduction. Okay. Problem 39, we got the first one is normal, second one is pretty straightforward. The son being blind does not make a difference. It has to be one of the two people filing jointly blind for it to affect the standard deduction. For C, both have to itemize when they're married filing separate. One itemizes, the other one has to as well, so both of them have zero standard deduction. $1,100 for Karen and D. For E, he's 65, and so 1,650 extra standard deduction. Zero for F because he's a non-resident alien. Manuel and Esther together, one is blind, one is over 65, so each of them gets the extra standard deduction. So there's two of those, so 24 plus the 2,600 equals 27,000, and then the last one, qualifying widower, plus the 1,300 for being over 65, so 25,700. Remember that qualifying widower is a temporary situation for 2 years after a spouse passes away, so that's gonna change in either next year, the next year, or something like that. So just something that you want to make sure your client is aware of. Problem 42, we're going to really hammer home the idea of subtracting out the standard deduction, getting our taxable income. How about we make this a little easier to read? All right, and get rid of the zeros. All right, so that makes it a little easier in there. This is our taxable income. This is the income. If it's under 100,000, it's from the tax table. If it's over 100,000, it's from the tax rate table. Here we had negative taxable income, which doesn't result in a negative tax, just simply means there's zero tax liability. But here's what your tax liability should be in each of these cases. If you want to look at the formula for some of the ones that have to do with, you can see them up here, where I had to use the tax rate table. Okay. And then problem 43, a little bit about penalties. Don't want to do this, don't want to go there, just avoid penalties. But if you forgot to file and pay for a couple of months, then it's 10% of the amount owed, or 5% per month. So it was within 60 days, and that's 2 months. So his total liability would have been 25,500. He had paid the 12, 8,500 still owed. So they would if they did pay at least what they paid the year before, so they don't have any estimated tax payment penalty, but they do have the failure to file and pay. If they had filed on time and paid the $8,500, then they would have avoided this $850 penalty. And even if they would have filed an extension, then they would have only had the much lesser failure to pay penalty. People are like $85 than $850, a big difference just for missing that filing of an extension, which is not hard to do. It's pretty easy. Then we have situation again with how much they've already paid in, and to avoid a penalty. So remember, it's 90% of the current year, or in this case where he's 155 this year, it could be 110% of last year's. Well, that would have been more than the 90% of the current year. So we're going to use the 28,447 times 90%, and then subtract out the 24,000 we've paid in withholding, and he would have had to have made $1,602 approximately, or $400 per quarter. So yes, if he'd have paid $1,000, he would have easily avoided the penalty and actually had an overpayment. So he would have should have paid about $400 per quarter, and that would have put him right at the amount that he needed to pay to avoid the penalty. Now he still would have owed some because remember that's based on 90%, so he still would have 10% that would have to be paid with the return, but he would have avoided the penalty. Okay. And then problem 45 is kind of the scenario. They come to you, they've asked for your help in trying to figure out how much they need to pay to avoid the penalty. We got some additional income. They're in the 22% tax bracket. So if you look at kind of a rough estimate of what they would need, you could either use the tax rate tables, or you could just add the 7,700 onto what, if you trusted they're already, the estimate they'd already given you. But both of those is going to be far more than last year's tax. So 100% of last year's tax would be 12,202. So we can avoid penalty by just paying up to the 12,202. We've already withheld 8,015. So we could get by with paying in $4,187 to avoid the penalty. And because it was in the last quarter of the year, that they would have till January 15th to make that estimated payment and avoid the penalty on estimated payments and so forth. So the 90% of the current year liability is much higher, as we mentioned earlier. So that's your answers. So make any needed corrections, and please feel free to post that back into the Dropbox once you've made those corrections. So take care.